It's a privilege to be here, although my predecessors have somewhat risen the bar super high. I will caveat that I'm not as inspirational a leader, so my role here is to be the boring nerd, bringing all of the data. I'm going to set the stage for what we believe is going to happen in the luxury industry over the coming years. So necessarily you will hear me echo some of the trends that both Louise and Florian have mentioned. I'm going to bring a few provocations, probably more in reaction to what Martin was saying at the beginning. But that's when the fun kicks in, right? Where is the clicker? Here we go. So just my shameless plug of advertising for Bain & Company. As you know, we are one of the 3 biggest strategy consulting firms globally. Generally, when people hear you say part of the 3 biggest, they necessarily understand you're not number 1 or number 2. So that's my humble statement. But we happen to be generalist consultants. We also happen to have unparalleled experience in the luxury sector. Over the past 15 years, we've worked with probably 100 of the most important brands and luxury houses in the market. Out of the 300 that we track in our luxury study, we know the industry from very diverse angles. We know it from the standpoint of operating a group, multi-brand group. We know it from the standpoint of operating in various categories and segments, be it fashion, be it jewelry, be it high-end watches, cosmetics, fragrances, etc. We also know the distribution angle, which is particularly relevant, for example, when you are not operating own retail, but working through wholesale. That's essentially how the US market works, for example. And so we've worked with department stores, specialty chains, etc. And we also know the investor point of view, because we've worked with all of the leading private equity funds who are interested in investing in luxury. We also happen to be in a unique position to observe the market, because we have been publishing a study which has become the reference in the industry, both for luxury players, but also for all of the luxury ecosystem, including financial analysts and investment banks, etc. We just published, as Martin mentioned, the 15th edition. I am in the tedious process of writing the report that goes with it, which I promised to Katja and Tatiana will be sent to the participant group before the end of the year, as it comes out slick and polished. I will start with a few words on what we've been seeing in 2016, but we thought it was more interesting to actually try and get the long-term perspective and project ourselves out in the future, trying to get away from the volatility of the previous 2 to 3 years and trying to see where the line is taking us and what kinds of trajectories we are seeing. Like I said, I will echo many of the things that have been mentioned. I will just bring the facts behind them. And so you don't need to be taking notes, I assume, because the presentation will be distributed. You don't need to be taking pictures of the slides because they will be shared. But if you want to Twitter, I will not be able to stop you. So, bigger perspective. What do we call luxury? So, what we track in our luxury study is one primary segment of a broader luxury ecosystem. We focus primarily on what we call personal luxury goods, which is defined by what is classically viewed as luxury products like fashion, jewelry, beauty categories, watches, handbags and accessories, etc. But we do also try and get a bigger view of what the entire luxury market entails. So you see that in 2016, it was a market that exceeded €1 trillion in retail sales value. We don't track the revenues of the players. We actually convert everything back to retail sales value, if only to be able to be comparing apples to apples between players who have very different business models, wholesales versus retail, licenses versus full line, etc. So that is naturally an estimate, but it is based on the analysis of, it's a bottom-up and combined with top-down views of the market. Titanic work, by Titanic I don't mean the boat, I actually mean Titan as the giant, but it's enormous work that goes into ensuring the reliability, comparability, and consistency of that data over time. So what happened in the past year? The global luxury market grew by 4%. That's the number that's circled at the end. But what is interesting on that chart is that you will see that, so luxury cars may become out of fashion, but they're still benefiting from tailwinds, particularly driven by the equipment of Chinese households. The luxury goods category has actually not fared well. That is not a surprise because we've been, for probably 3 years now, we've been telling the market that we were getting to a point which we call the new normal in luxury, which is structurally defined by slower growth. And as Louise was saying, there are no more magic bullets, no more emerging markets that are suddenly going to be leading the market into growing double digits over a sustained period of time. But to Martin's point that products are not going anywhere, the market is remaining relatively stable. The one thing which has been growing, which we can see in the rest of the growth rates, is actually experiences. Luxury hotels, wines and spirits, fine foods, fine art, luxury cruises. It seems that people are actually shifting their spending to things that are more experiential, service-driven, that make them feel better about themselves and just feeling like they're investing in their own welfare and well-being. And so we have seen that shift, and it's actually been continuing now for about 2 years. This is the personal luxury goods market in and of itself. So this is what the landscape defined by competitors such as LVMH, Kering, and the likes, defined by the categories that I was referring to earlier. So pretty impressive picture if you look at it over the long run. So over a 20-plus year period, this is a sector that essentially has been growing all the time, with the slight hiccup in 2008-2009, which was related to the financial crisis. But essentially, it's been growing for over a sustained period of time. The average from the top of my head is 7% per annum over the long run. So it's actually more than tripled over the period. We are getting, as you can see in the numbers that are circled on the right-hand side, and sorry, bear with me for a second. The red bubble is the growth at current exchange rates, and the white bubble is the growth at constant exchange rate. Because as you can see, there's a lot of volatility that is driven by currency fluctuations, and so we have to take that into account as we track in a single currency. So the pattern is the following. Over the past 3 years, the growth has essentially been decelerating to a point of actually reaching stagnation this year. We actually think that there were exogenous factors driving the sub-performance of the market this year. Our view in the long term is that we should go back to something which is positive, but in the lower single digit. We'll talk about that later, but this is essentially the landscape in which the various players have to operate now. So as you can see, there is quite a change in paradigm between a sector that was up to 5 years ago running at probably plus 12% per annum, and in certain regions like China was growing at plus 25%, and the current stage where we are not seeing growth. And it's as you know, underlined by some of the news that Florian was sharing, which is particularly true in watches, but we're starting to see layoffs. So this was a sector that was recruiting heavily, and it's now shifting to something slightly more diversified between the various categories. What happened in 2016? Literally just a snapshot of the year, and I won't spend too much time on it. But as I said, stable market in both nominal and real terms. A lot of geopolitical tension, which impacted consumer confidence. So we've been seeing Brexit, we've been seeing the suspension or the freeze of the U.S. market as everyone was waiting for the election times to be over. We've seen the impact of the terrorist attacks in the European market, certainly in France, but also interestingly enough in markets like Germany. probably because many of the Chinese consumers who are visiting Europe happen to be bundling a number of markets together, and so when they don't come to one, they don't come to the other. By and large, this is still a market that is focused on Western developed markets. We'll talk about it later. This is one of the themes that we're trying to bring back to the table. But it is really dependent on global tourism. There is about 40% of the market between Europe, the US, China, and Japan, which is generated essentially by tourists, incoming tourists. And so it creates a lot of volatility when those tourists go away. The US market, and I want to emphasize already at this point that what happens in the US is critical for the global luxury market. Martin was talking about Asia, which is not going away and is going to be back. Certainly the US market is not going away, and we are crossing fingers that it is coming back at some point because it does have a tremendous impact on what is happening. So unsurprisingly, luxury not faring well this year globally because the US didn't grow at all and actually slightly declined. Europe lost the touristic support, and we've seen an interesting phenomenon, which is the revitalization of the mainland China market. For the first time in 3 years, in constant exchange rates, we have seen growth in that market. It remains moderate, plus 4%, but there are some signs that the government is actually trying to stimulate domestic consumption by emphasizing luxury, which is good news, certainly for the industry in China, but also hopefully for the broader, the global luxury industry in the end. And then again, second year in a row, a massive impact of currency fluctuations. It played upward last year. It's actually played downward this year. So trying to move away from the tyranny of short-term trends, we've actually tried to frame what would happen just by looking at the numbers in the global luxury industry. We are going to highlight 8 themes. It's always subjective. I could very much come up with 15 if you asked me to. I could also emphasize just 5 if needed. The 4 at the top will be defining where luxury is going to take place, so to speak. And the line at the bottom is more about the change in the business model, more about the evolutions of the how luxury is going to be operated. And so let's start with our few themes. I've started alluding to it, but there will be a persistent dominance on the global radar screen of the Western markets. You can also highlight, and somebody was talking about urbanization earlier, but the growing, the importance of mega cities as part of the ecosystem of luxury. This is a phenomenon that we've been tracking for a while, and it continues being very interesting in terms of concentration of where the transactions are taking place. Unsurprisingly, we are going to re-emphasize the critical role of Chinese globetrotters for the future. This is not a new phenomenon, but we have all reasons to believe that it's going to continue. There are, however, going to be some changes in the types of Chinese consumers that we're seeing, and we'll talk about that. The unstoppable rise of alternative channels. So we are moving away from wholesale. The market is increasingly retail-centric. And within retail, we are seeing a new breed of channels emerge and actually grow relatively fast. I'll highlight 3 specifically as part of this presentation. We'll get back to the details later on. We're going to talk about, in the how of the business model, we're going to talk about the great generational change. A lot of challenges for luxury brands as the new generation is emerging and coming up, and so we'll talk about that. Truly omni-channel. There is a bit of a desynchronization between how people operate as consumers. That was one of Florian's points, but the way you behave as a consumer in many times doesn't translate in the way you manage a business. And so we have to resolve that dichotomy because it is going to happen. It is there already. It is changing the competitive paradigm because luxury is not a confined environment. You actually compete with lots of different experiences, lots of different competitors, also coming from the mass market. And the reaction of the industry remains persistently slow. We're going to talk about sustainability and green as the new black. And to Louise's point earlier, it is not something that drives people to buy, but it is nonetheless become table stakes. And then finally, we'll talk about the next frontier of technology. We can talk about products, but I'd like to talk about production processes more, just to be provoking the industry and the way it thinks. So let's start with the Western markets. This is the picture, the global ranking of the personal luxury goods market by geographical area, and it always strikes me when I present this slide because I've been using it quite extensively, and so it feels to me like it's déjà vu, but it always surprises people when I tell them that the US is the biggest market globally, because there's been a lot of buzz around Asia and China, but it's because people are focusing on growth rates, not necessarily on where the market is generated in absolute value. But essentially, it takes Japan, China, Italy, and France combined to try and match with the size of the US market. Generally, a lot of journalists ask me questions around when is China going first. That was particularly true in the period when China was going 25%. But essentially, it would take 20 years of growth at 7% per annum for China to be at the current level of the United States. And presuming that the United States won't be in a standstill in the period, they're actually never going to match them. So that world order is going to remain true for the long term. If you combine, so that's US, and then if you combine it with Italy, France, UK, Germany, and even if you wanted, you could combine it with Japan. You have anything between 60 and 70% of the global luxury market. And so yes, the growth is in Asia, or was in Asia, is going to hopefully revitalize in Asia. But Western markets are absolutely critical for luxury brands, and they tend to have been somewhat forgotten from investment strategies in the past 5 years. And so we are working hard to bring them back on the strategic agenda, but that's something to bear in mind. If you don't know what is happening in the US luxury market, you are not going to be a relevant executive in the luxury industry nowadays. So an interesting question is, if you operate in one of those Western markets, who are you seeing in the stores? And we've talked about the impact of tourism, and this is essentially the origin of consumers in each of the geographical regions. So in Europe, for example, Europe is the region which is most exposed to tourism, and so unsurprisingly, when tourism goes away, you can see the result on the industry's performance. Local consumers, about 45% of the transactions nowadays. In the Americas, we have about 1/3 which is generated by tourists. The West Coast has heavily suffered from the departure of Chinese consumers, just because the US dollar was too strong in the past 2 years. But it's becoming slightly more volatile than it's been in the past. And we'll talk about the origin of those extra regional tourists, because it may be shifting from year to year. It's kind of hard to track. And the biggest chunk of those tourists, which are, again, unsurprisingly coming from China, happen to be changing destinations quite dynamically based on price differentials, currency fluctuations, etc. So you can't place your eggs in just one basket. You really have to figure out strategies to cater to the local consumers, but also strategies to cater to tourists despite the volatility. And no one but the Chinese buys in mainland China, which I think is an interesting chart as well. If we take the opposite spin of, if you are a European consumer, where do you actually buy? You, or an American, sorry, I'm shifting the wrong presentation. So European and US consumers buy domestically. They don't travel to buy luxury. They have everything they want at home. They don't need to be traveling for that. They don't need to benefit from price differentials. There are no effets d'aubaine with those consumers. So essentially, if you want to serve them, you need to serve them locally. And you need to bear in mind that you have half of the traffic, if not more, at the point of sales, which is tourists. And so how does that mingle, with the local population, and what kind of experiences is it creating for them when they have to wait in line for 45 minutes because there's a group of Chinese consumers which is here to buy and want to be served with the same protocol and service standards as any consumer would expect. Japanese, we will see another chart later in the presentation, which is their contribution to the global luxury market. If you roll back 20 years ago, they used to be one of the core buyers of luxury. They've actually shrunk to a much more marginal portion of the market. And they buy primarily in Japan and Asia, whereas they used to be flocking into US and European stores still probably 10 to 15 years ago. So a lot of changes in the kinds of demographics that you have to manage at the point of sales. And Chinese consumers, well, it's only 1/3 of their purchases that they do in China itself. So I liked Louise's point about origin and destination, because in the way you invest in the market, you have to bear in mind when you invest in China that you're creating the plug for a purchase that is going to take place elsewhere. So the way you measure return on investment, for example, totally needs to change. But if you haven't created that plug, they won't be coming to the store in the European market or in the US market. So some of the facts that we like to think about, because they create a lot of complexity and challenges for how to think about a lot of investments. So we're talking about megacities now, shifting the geographical angle from slightly and trying to come up with something different. So this is essentially the top 20 cities in the world by way of retail sales value generated in personal luxury goods. And the shading is, the light pink is less than 5 billion euro. The light gray is between 5 and 25. And the red is above $25 billion. Euro. So first point, New York in itself is the biggest luxury market globally because it exceeds Japan, which was the second biggest market. So again, and very different business model, obviously, because very dependent on wholesale and department stores, etc. But a big concentration of luxury value there. London, Paris are actually pretty meaningful markets in and of themselves. They happen to be it's reflecting the economical construction of the local landscape, but essentially they represent 70 to 80% of the total market value in that market. So Paris is essentially epitomizing what is happening in the French market. Similarly for London, the other market which is like that is Moscow. The Russian market is essentially defined by Moscow, and naturally Dubai because the Emirates is just a smaller market by definition. So we are seeing pockets. You combine these 20 cities and you have about 60% of the total luxury market. So if you want to be thinking about investment strategies, store footprint, I think this is interesting data to have in hand. Let's talk about those Chinese contributors. Back in 2013, we did some analysis to actually try and put a number on luxury consumers globally. And we came up with the number of 330 million consumers who are buying in luxury as defined by certain criteria, which include the size of the basket, the types of brands that they're buying, etc. Of that, we had 48 million, which is 14% of the total that was coming from China. Fast forward to 2020, there is about 60 million of new consumers that are going to start buying in luxury, all coming from China. So China will contribute 80% of the new consumers that are going to start buying in luxury. And we are talking their share will rise from 14% to 26% of the total. That's a number of consumers, because I'll also have another stat, which is share of the value they buy, share of the total market. And back in 2013, they were far outranked by the Americans, for example, who represented 34% of consumers. In 2020, Americans will represent 28%, so and Europeans 26%, on par with the Chinese. So it's a significant change. We're talking about all new consumers reaching the market, significant change. And the one thing you need to bear in mind is they're all coming from the middle class. So it's an emerging middle class. We've seen up till now the more affluent Chinese consumers. We're going to see a new wave of consumers reaching, and they have different types of aspirations, different brands that they aspire to, different types of experiences that they find rewarding. And so we need to get to know them quickly. In terms of contribution in value, essentially back in 2000, they were nowhere to be seen. Like no one 16 years ago was talking about China when it came to luxury. 1% of total purchases globally, and you can see here, for example, the importance of Japanese at the time. You fast forward to 2020, and there are 34% of purchases, more than 1/3. It can be volatile because last year they represented 31%. They actually declined this year. They spent less abroad than they've been doing historically. And so we need to be doing everything we can as luxury brands to understand them, get in touch with them, start a relationship with them, and then keep them in the long run, because it's going to be critical. They can go away if they don't have a specific attachment to the brand, for example. Interestingly enough, we've also seen their purchasing behavior evolve. They used to be big buyers of goods, and we are increasingly seeing them in other categories, and particularly the experience-related ones. And so they are increasingly becoming, in terms of aspirations, buying power, and also buying behaviors, they are becoming similar to the customers that we are used to from the Western markets. Let's talk about channels, and again, I'm not switching the right screen, so sorry about that. Unstoppable rise of alternative channels. Big picture, 70% of the market is generated in wholesale channels, 30% in retail-oriented ones. But you can see now that the share of 3 specific channels is going to radically increase. So we've seen the emergence of off-price stores, and a lot of it is actually related to the emergence of those Chinese consumers. Thankfully, it is a better controlled channel now, because a lot of brands have been investing in understanding the outlet model, trying to figure out the destocking models, and so they have better control now, and the level of discount has been contained this year. Online has been growing nearly 20-fold in less than 10 years. So it's a market that's now reached 19 billion euros in value. If you have those numbers from the geographical markets in mind, they've essentially now, they could be defined as the 3rd biggest market, right behind Japan. So online sales are growing really fast. Since we've started tracking that market, we've never seen a year without double-digit growth. This year is the first year that it's actually below 20%. So it's still, bear in mind also, it's still outperforming the rest of the market with 13% growth this year. We forecast that it's going to double by 2020. And so that is a reality that luxury brands have to come to grasp with, not just from the standpoint of e-commerce, but from the standpoint of digitalizing the relationship and building seamless relations with customers throughout the customer corridor. And finally, airport, unsurprisingly, has been benefiting from that big travel trend that we've been talking about. Very focused on beauty, very focused in the Asian market, in the Asian region, but still continuing to grow in the high single digits this year, for example. So channels to to be taken into account for future strategies. The one thing that I say about the online channel very regularly is this is a market, or a channel, sorry, that the brands have relegated to other players in the ecosystem. We were talking about Yoox and Net-a-Porter. They have actually been managing to capture a significant share of this market. So what we call retailer.com here at the bottom is essentially the online arms of the big mainstream retailers, such as the department stores in the US. E-tailer are those new business models with online pure players. And brand.com is our definition of the sites that are actually operated by the brands themselves. 1/3 of the market, that's it. 2/3 of the market is going to other players in the ecosystem who have been more agile, more flexible, more adaptive, who have been growing on the back of that. And as you can see, we are not foreseeing a big change in the structure of the market between now and 2020. So hopefully the battle is not over, and hopefully brands are going to jump straight to the next generation, which is mobile, and not just online commerce. But it's a bit of a pity to not have surfed on that particular wave. Generations. There are a few factors that are coming in, and so particularly the diminishing contribution of baby boomers. It's not just that they are not interested in luxury, it's actually that they're dying out so progressively. So sorry, that's the sad collateral effect of doing some socio-demographic analysis at times, but we are going to see the emergence of Generation X and Generation Y. For those of you who are unfamiliar with the term, Generation X is someone like me. Sadly enough, I'm that high on the chart. Generation Y is more the people like you. And Generation Z, which there's a lot of talk about Generation Z, but bear in mind that they were born 16 years ago approximately, and so they are not contributing a big chunk of the luxury market between now and 2020. That said, we do know that they're going to have very different behaviors, and particularly that switch from possession to usage is really disrupting the business models for the future. Omnichannel. So a lot of companies understand omnichannel as I need to have an online store. This is a very, very reduced definition of what omnichannel would be. What we call omnichannel is the seamless integration between all channels in an effort to bring an experience that is as delightful as possible to a customer. And it's not just about becoming an online player, it is also about using the store in a totally different fashion than what has been the case historically. So I'll just give a few examples because I won't have the time to present the entire slide. But if you think, for example, of research and trial, 75% of people will pick a store on the ability, or will prefer going to a store for the ability to try and feel the product. So stores are not going away in luxury, but we need to rethink their role in the total relationship. They might be here just for trial purposes. They might not close the transaction. It might go online, but that's not the point. We need to think of customer economics and P&Ls, or we need to think of catchment area economics and P&L, but the sort of channel by channel view of this is the profit that I generate in store versus online is not going to work anymore, because we're already at 7%, almost 8% penetration of the online market in luxury. At 10%, the store economics are fundamentally changing in nature. It is impossible to be making profit because high fixed cost, not a lot of incremental purchases are coming from online, from what we're seeing. So it would work if it would open new markets, for example, but if it's just cannibalizing from the existing stores, it's not working anymore. So fundamental rethink needs to happen around the footprint and the role of the store. Another example, in terms of purchases, there are no better substitutes to a store to generate unplanned purchases. So 80% of people who go into a store end up buying, 65% end up buying unplanned versus 45% online. So you can't get rid of stores. You need to continue operating them, but you really need to define a role that is taking into account the fact that they might end up buying the product elsewhere. And it's going to, so I talked about the role of stores and the size of the network. There are a few other things that need to happen. So we need to think about how we invest in the store, in particular through digital tools and applications, et cetera, to enhance the experience. And then we need to start doing something with the data. The luxury industry is lagging behind in terms of customer understanding. There is this principle that it's rude to talk to customers. It's rude to understand what they're aspiring to or what they think of the experience. You might be sitting on loads of data that are totally underutilized, but we're going to have to become smarter about the data, about what it says about our customer behavior, and about what to do about it. So lots of changes that need to happen. I think there's a section on analytics and data later in the day that might be enlightening from that standpoint. Supply chain and logistics. If you think about catchment area economics, so you literally look at where the customer is living and you try and understand how much profit you're generating across channels in that area, it actually drives to a number of decisions in terms of how you operate the inventory, for example, or the supply chain. And if you're going to be fulfilling from store, because it actually diminishes the delivery times. So there are lots of things that have deep supply chain and logistical implications, which a number of players are not even coming to grasp with still at this point in 2016. And finally, organization and capabilities. We spend a lot of time helping retailers and luxury brands with their omni-channel transformation. At the end of the day, the one thing that makes the difference in making the strategy successful is not the strategy itself, because a lot of players are doing things that are relatively similar from the standpoint of customer engagement and applications and the use of digital, et cetera. The one thing that makes the difference is the ability of the organization to actually implement it. And it does require significant changes in culture, in behavior, in speed to action, and we're seeing a lot of slow things unrolling at this point. That's the one that I need to shift to. Sustainability. That is what Louise was talking about. This is from a study that we did with the, can't remember if it was the Wall Street Journal or the New York Times, sorry. Essentially, if you ask consumers if they will buy a brand because it is sustainable or is engaged in a variety of philanthropic initiatives, 9% are going to say, yes, I am definitely influenced and I will buy that brand particularly for that. If you sort of lower the bar and say, would you consider changing your consumer behavior, your shopping behavior based on their ethical conduct, you might go as high as 14%. From an economic standpoint, if you're a manager in a business and you think maybe 23% of people out there will want to buy because I'm sustainable, you would not do it. But that's not the point. The point is it's table stakes. It's table stakes because 83% of employees in luxury brands think that their companies should be engaged in philanthropical initiatives. And as you know, employee engagement is a core driver of company performance. If you think of consumers, the 60% of luxury consumers think that luxury brands should be more engaged than any other company in any other sector in philanthropical initiatives, or honesty, or integrity, or sustainability, whichever way you want to define it. If you think about investors, those companies, we did a bit of analysis on the financial crisis, and those companies, including outside of luxury, which had sustainability strategies that were super clear and engaging for investors, had a stock price recovery that was 8 times faster than the average. And finally, we've tried to put a number. Like, so the study's title was "Can you quantify goodness?" And essentially, we tried to put a number of is it an investment that will return a profit at some point? Just from the standpoint of press coverage, you can actually get a return on your investment. The analysis that we've done was that of all the luxury brands we've looked at, we estimated that they were investing about 750 million euros in their sustainability strategy, and they were recovering 1.5 billion euros on press coverage only. So the equivalent of actually buying the media. We put a price tag on that, and so it's anything between a 1.5 and a 2 times return on investment, depending on exactly how you round the numbers. But that's worth it, and like we said, it's table stakes. Like, you can't do without it. Final slide on those 8 trends. Let's talk about technology for a second. Some companies have been quick to adopt technology as something which is embedded in the product. And so that is innovation, if you will. But it's highly replicable. And so it's becoming difficult to justify the price difference if you're doing essentially an Apple Watch, but probably less well than Apple themselves. And so we've seen connected products, we've seen new fabrics that are connected as well. It's going to continue more as experiment, I think, at this point than anything else. The watches are actually a scale business by now, but the one thing that we're more interested in, because when you think about an industry that is going to grow at a relatively moderate percentage, you actually start thinking about cost reduction, which is so far has been a foul word in luxury. But you start thinking about the production processes. And so you think about 3D printing, you think about laser cut, you think about a number of things. So we have examples here of 3D printing makeup or jewelry or shoes, etc. The interesting part about it is the fact that it substantially diminishes the cost of production. It's not for the product that it generates, but it's more from the standpoint of, can you actually create efficiency effects in an industry that's been heavily focused on manual handicraft? And if so, can you actually justify the price premium, the distinctiveness, the exclusivity going forward? So it's more food for thought at this point. We don't have numbers to provide that. It's the one slide where we don't have numbers, but bear that in mind for future uses. What is going to happen? So we've been talking about the changes in revenue growth over different periods of time. So you can see that we are projecting anything between 2 to 3%, maybe 3 to 4 when we are optimistic. That is, of course, I don't have a crystal ball. None of us have, but that is, not thinking about anything between like nuclear war or major geopolitical event or massive currency fluctuation. So that is at constant exchange rates. What are the themes that we think are going to be critical for 2017 first? Hopefully we're not projecting massive growth for next year, 1 to 2%. Essentially betting on the recovery of the consumption in the US. And the rebound of Chinese global spending. We're hoping that Europe is going to be maintaining its relatively resilient trajectory. We don't think that Japan or Hong Kong and Macau are going to get out of the gloom cycle that they're in. For 2020, you might have heard me talk about many of those trends, but it really is about the Chinese middle class. It's also the recovery of consumers in the Western markets, but the increasing relevance of Generation Y and X, etc. So these are some of the underlying drivers of the market. One of the things that we've been seeing is that in easy times, it is very, very easy for a lot of luxury brands to be successful. And so they are essentially betting or surfing on the tailwinds to be generating growth. So in those 2 periods of time where we had 7% growth or 9% growth, essentially 87 or 93% of companies were able to grow. That is, as revenue growth defined by superior to 0. And half of the sample back in the days, 56% were able to generate double-digit growth. If you start seeing different dynamics, then it becomes much more difficult. In crisis times, 30% only were able to grow. 12% were able to generate double-digit growth. In the current phase that we're seeing, half are still able to grow, but by single digit. And it's as tough to generate double-digit growth as it was in the financial crisis. And so we are going to start seeing who is actually managing a luxury business well. and not just being carried by the tailwinds. And just a few themes to bear in mind. We've been talking about how we need to reshape the strategic agendas of luxury CEOs. I'll just drop a few themes. I won't go through the entire slide, but there's been a lot of effort that's been done on pricing in the past 2 to 3 years to try and reconcile the gaps and minimize the differentials, and that work is done and properly done. But we're going to be talking about one-on-one customer experience. We're going to talk about the new role of store. We're going to start talking about productivity management, a pretty new theme in luxury. Scientific customer corridor management, that's where the data comes in. So you can see that in times of difficulties, you really need to switch gears and go back to the strategic boards. You really need to redefine your strategies, because what worked in the past 5 years isn't going to play out successfully in the current environment. And with that in mind, I will leave that to the next speaker.
Fantastic. We will just have time